Good weekend all. Ira Epstein with your Spider ETF stock market wrap-up. And this wrap-up is for Friday, the 24th of February, 2023. And we're sitting here now with our weekend edition, which means we're going to look at weekly charts. So instead of looking at the dailies, we'll look at the weeklies, get a bigger picture. What is the market looking like? Now, I'm going to tell you up front. If you're a student of the Bollinger Bands, the way that I teach them, the enhanced Bollinger Band course, a lot of this was foreseen when you lost embedded readings. For those of you that don't know it, at the end of this video, we'll give you the opportunity to see how you can get into the course and what you do with that. I think you'll find it fascinating. Now, the day's event. Behind me, you see an awful lot of markets that are in the red, but not all. USO, oil was up a little bit. There was a few others right here. SLB, I was looking at, that's up, but the vast majority down. XLF was up. Most markets got hit today. Why did they get hit? Because the market saw a signal, and the signal came from the PCE price index, and that was it. I've highlighted it for you. Month over month, the market was up 0.6%. The prior was up 0.1. So January was 6 times as great as December. And year over year in January, you went up 0.4% from the 5% before. It's all the wrong way. The market's looking for it to go 6 times down on a month-to-month basis. That's what you want to see. And at least on the year over year, where's the tipping point and the market starts falling back? Was this enough to get the Fed to go bonkers and say, I'm going to go to a 0.5 point instead of a 1/4 point? I don't think on its own it is. And the reason is they're still looking for that lag impact. Where does it come in? That's what they want to know. We've gone from basically 0% interest rates to close to 5%. At some point, they're looking for where's the inflection point. And when they get there, if you watch auto racing, and you know that's the beauty. You watch F1 racing, you learn so much. And having tried my hand, not at F1 obviously, but at open car wheel racing, you learn to use braking systems to pull the engine and so on to slow things down. You're trying to speed up, and then you got to slow down to make turns and apexes and figure out the chagrin, everything you're going through all these markets, all right? Well, as you go through them, you say to yourself, okay, I got to throw the balance. Well, that's what the Fed is doing. The Fed is looking for a balance. How does it balance this out where they raise the rates and instead of tipping the economy over, what happens is the inflation stops going up, starts going down, and they can pull back by pulling back on the throttle, letting the engine do whatever it's going to do, and the market coasts into where they want. Do I think they'll get to the 2%? No, I've been consistent. I think the new number is a higher number than that. Why people went to 2% is beyond me. It's a school book number. It's probably not reality when $1 is no longer worth $1 anyways. Just the way that I'm going to view it. So as we look at these charts, let's understand what we're looking at. We're looking at weekly charts. So for the week, the market has come up, fought a battle up here, starting to come down on the SPY. The pattern is one of a lower low and a higher high. This brown line is called a swing line. And what a swing line does is it looks at the prior week and it says, do I have a lower low? Do I have a higher high? Do I have an inside week? Do I have an outside week up or an outside week down? If you understand those terms, it's one of those 5, and I create an indicator that says, okay, I should be able to take any kid. I did this when my son was 13, by the way, and I said, you will be able to go anywhere and sit with adults and tell them what the trend of the market is. And my son's now 38, so it's a long time ago that I created it. I use it day in and day out. And right now, you're not trending. You have a market that had a vertical price rise and pulled itself back into a correction mode. When we come and we put on moving averages, you never did make it to the 100-day. That was a natural resistance point. Big moving averages people look at. Why? Because the herd uses them. It's really that simple. Moving averages don't project forward. They tell you where resistance is or support is based on past events, and you're plotting them out, whether you use a 200, a 100, a 50, an 18, whatever you're comfortable with. People use them in different ways. Well, the neutral number on a chart is the 18-day average of closes. That is where I contend the market's going to try to figure out what to do next from. The next number is so important. It's called a Bollinger Band. In the Bollinger Band, this is an algorithm that was designed to keep the market trading within it 95% of the time. The market will break out of Bollinger Bands when they get super narrow. When they're wider, the market doesn't do that. It'll pay attention to them. And when you run up, especially towards a combination of a 100-day average or a 200-day average and a Bollinger Band, it is that number that the market will often see professionals say, I'm coming out of the market. Now, some professionals use the number. Some might say, hey, if you get within 1% of it, 2%, I don't need to be with the whole herd. Maybe you won't hit it exactly, but I know I've got to start liquidating money. Think about what I just said. If 95% of the time it does that, that's how they think. So as we come back on this particular part of it, if we come together and you look at the Bollinger Band, and you'll see this on many, the band itself number was 418.21. You got during the week to 418.31. That's where I contend that they were taking money off the table, and now the market starts turning itself back and you're coming back down. You're going to see this pattern on chart upon chart upon chart, and it often goes where they'll say, if the market embeds, or if my momentum, it could be an MACD, it can be RSI, it could be as I do with slow stochastics with my own formula, my variation of it. If it's not embedded means both numbers are either going over 80 sideways or under 20 sideways. Barring that, they either get overbought and oversold the traditional way. No, then I think the pros are just coming out of the market. They're not taking it off piecemeal. When we come to KBE, it's the same thing. So 4 weeks ago, you had your warning sign. You were overbought. That was the spot. Now think back 3 weeks ago. How bullish was everybody? This market started going up as a whole, the stock market, on December 30th and went up right into an end of January. It just kept going, and then into the early part of February. You remember that? First week of February was where the crack started showing up, and now you're back down to the point where you're getting neutral on, be it the stock indices and many individual stocks. They travel together often. KLI, what happened here? Real important today. Because what the market did is this market, if we come here, has been embedded. This is the week of the 17th. If you lose the embedded reading, which you did, the market often is going to make a run to the closest main moving average underneath it if you had a bullish reading. So closing at 131, the 18-day average is 99.88. And you hit 99.40. It did it all this week. It's a weekly chart. The dailies give you even more time often to play with that. In XLE, no, we've been bearish. You've had lower highs, lower lows, and you're now coming to the support here of the 18-day average of closes. Momentum coming down. I think professional traders will be covering shorts against 82.51. The low this week was 82.79. They can get it there, they'll do it. But it's sideways action. It's always difficult there. Now, in foreign currency trade, you lost the embedded reading when? I'm going to keep saying embedded reading. It's not that I'm married to that. It happened. And you have to see it because you had edges. Here's the market starting to wobble. You didn't quite get under 79. You do this week. That was last week. Where do I think you're going? Before you get over that high, I say you're going to make a run at that 18-day average of closes. To me, this is so important because it warns me if I have bullishness about me, temper it, Ira. You're probably going to get a pullback in the market. Do I know it's going to work? There's a high probability it's going to work. That's good enough for me to pull back my trades. Now I have an overbought market. I'm not locked in to the uptrend, and this is what you got. You're going to see this over and over on the charts. Gold did the same thing. You lost your embedded reading here. You're now into the support zone. I've been prepping you and telling you that there's a cycle low due in gold. I've also thrown on my other hat, a Jekyll and Hyde. My chart side says I'm looking for a low to develop. I'm not going to go fishing for it. My Jekyll side says, why do I want to buy it? I can get 5% interest rates on a 6-month instrument. Gold pays me nothing. 5% for not taking a risk. Inflation may be at 5%. I've hedged myself. That's the dilemma. In the gold miners, if gold is coming down, why do I want to own the miners? I don't. It's that simple. Tesla. Okay. Are you overbought? By every measure, I know you are overbought in Tesla. And I know what you're going to tell me. Ira, this stock is going. It's a stock that's 200. Kathy Wood says it's going to 1,200. I got to own it. Okay, then own it. The trend is up, higher lows, higher highs. The warning sign comes in if you take out not this week's low, last week's low. What was last week's low? To me, where I don't want to own it is if you get under 187.61, you're at 196.88. You're probably going to go back and hang around at that point, the 172.46 to the 200-week average, 180.44. Don't take that out. Okay, Kathy, I love you. Let's go to town. And maybe you can get up there into what the other people think. I'm with the bulls right now on the chart until that low's taken out. NVIDIA, I don't want to own it up here. Did you embed? Well, let's take a look. Certainly week one, both numbers are over 80. Last week, both numbers were over 80. I need 3 weeks in a row to be embedded. I have it. So what do I think this week? I don't want to own it over a Bollinger Band. I'm going to look real hard during the week at the zone of the 195, or am I? Now I start saying to myself, this is the first challenge of a 100-day average. One of my philosophies is the first challenge is always interesting. Example, you ran down here and you came right back and you fought a battle. So I want to see what the market does at 195.77 if the market around us is falling. If the market around us is stable and the market goes there, I'll probably nibble away at that market. I'm wrong if the red line closes under 79 in the momentum. This is a weekly chart, so you get plenty of time during the week to look at it. In Apple, overbought. Made a run at the upper Bollinger Band. Again, here's that same philosophy. First challenge of the 100-week average, over it. We haven't been over this in a long time. You flashed a few, but then you got thrown back. You flashed a few, you're getting thrown back now. So Apple on its own probably is an okay company here. However, everything around it is coming down because of what we saw in the PCE index. Is it a buy? It is not. When you have lower highs, lower lows, and you're over the red line, here's how I work that. The bias of the market is up. Here's my definition of bias. When a market is under the 18-day average of closes, the red line, I have downside bias. When it's over it, I have upside bias. You're over it. Therefore, while the trend of the swing line is down, because the bias is up, the target is 143.47, and that's where I'm looking the market to try to find a base. If it can't, we'll know so. It'll close under that number at the end of the week. Then you're back into a somewhat bearish trend. Risk would be 156.34, most recent high plus 1 cent, and maybe you're coming back down here. In Meta, what is the pattern? Bullish. The market got up to and over the Bollinger Band, never did embed, overbought, giving you a correction. Support all the way back at 132.54. Don't know if it'll get there or not. There's no reason to be bearish. It's still in the bull camp. TLT, battleground, 18-day average, no trend. Higher high, lower low, was overbought. It's just been drifting sideways since the whole beginning of the year, by the way, but it all began back in November, the sideways action, and it's still there. Sorry about the news there. So you put this together and you try to come up with a game plan. And what I keep showing you is the importance of understanding Bollinger Bands. I put this together. Please take a look at it. I'll see you come Monday.